Hey everybody, Tom Gentile. Welcome to our very special webinar that we're doing tonight. Those of you that are tool members that are here, welcome. I know your time is valuable to you as it is to me. But this was something that I've been wanting to put together now for the better part of the year. Joining me tonight, we're going to discuss the future of FANG. We're also going to talk about trading delta neutral spreads. But joining me tonight is someone that if you guys remember Jeff from Optionetics, he was someone that was well sought after as an instructor. He is a money manager too, so he has clients that he manages money for. But one of his specialties is trading delta neutral calendar spreads. So I thought this was a fantastic area in the middle of the year. This is a perfect time, by the way, based on the sector rotation that we're seeing going on in the marketplace. And so please help me welcome Jeff Beamer. Jeff, good evening.
Hey, good evening, Tom. Good evening, everyone.
Glad to have you in. And finally, you're part of the team. That's
Yeah,
exciting.
it's great to be here. Yes.
I know I've been wanting to get you in here for the last couple of years, and with our cream of the crop trader instructors in here, it's great to finally slot you in. And you were with us last year, so let me just make sure I let everybody know this. We got some partners that are in here tonight, and they're very excited about not only seeing you tonight, but seeing you on Calendar Mastery Series, which we're going to talk about toward the end of the program. But you did a session for the partners. It was only a small session last year, and it got a lot of fanfare. And that was one of the biggest reasons why I wanted to bring you back this year. And it's just, getting around to doing it now. But I guess better late than never, huh?
Well, it is, and the good news is that the markets always move, and there's always a group of stocks that make great calendar candidates. So it's not like we're going to miss anything.
Yeah, exactly. So, all right, guys. Well, let me go through the administrative rules that I do here, and then we're gonna get right to work. So, you can ask questions. Feel free to ask questions for any of you that want to say hi to Jeff. Feel free to put them in there. I'll pass the good words along. But if you have any questions about what we're going to cover tonight, feel free to ask them. I'm going to do a short session on a market update and kind of a FANG. We'll talk about FANG stocks as well, because they have really changed the landscaping for at least the next couple of weeks. All right, and I say that because there are some things going on that I'm actually really excited about. I don't think this market is done with to the upside yet, but we may see sector rotation, meaning that more and more old school stocks are going to be moving in a bullish direction, and we could see the pullback for tech continue. And I think that can continue for the next couple of weeks. So if you have questions, feel free. We're recording this session too. Everybody always asks, are we recording it? Yes, we're recording it. I'll get it out to you as soon as possible afterwards. I'm going to be giving you a slide handout sometime during the program. All right, we're going to make sure that all of you that are here have access to Jeff's slides. So you're going to have to hang around a little bit, because I'm going to be putting them together as Jeff is talking, and I will get those out to you sometime here in the next hour. And then finally, the disclaimer you see on the screen. Obviously, I put this on every single webinar we do. You can read this in its entirety. All you got to do is just pause the recording that you'll be getting later following this program. All right, but a couple of quick things. Obviously, all of us know stock and options trading has large potential rewards, but also large potential risk. The other piece that I want to mention right off the bat is that myself, Jeff Beamer, everyone that's associated with Optionetics and Tom's Trading Room, we're here as your educator, okay, as what we call publishers. And so we can show you how it is that we trade using strategies and how we put trades together and such. But we are not investment advisors. We do not give personalized investment advice, all right? We're not broker dealers either. So you need a broker to trade with. You must meet certain requirements, and everything that we're going to talk about tonight is in US dollars unless noted otherwise. That being said, let's go ahead and talk about tonight. So our focus today, I want to do a quick market outlook. I want to talk about the future of FANG. All right. Let's talk about low cost opportunities. And this is where Jeff comes in to talk about low cost opportunities for no more than $500 a trade, but often far less. And he's going to show you how we usually take profits on his type of strategies within 30 days or less in a market neutral environment. This is just one of several different ways that he trades delta neutral, and he's going to be teaching you tonight. So let's go ahead, and I blew these up so I can make sure everybody could see them. And so I want to talk about FANG stocks for a moment, and then we'll look at the big three, and then I'm going to turn this over to Jeff. So I'm putting these in order of the earnings report. Okay, so first we saw Netflix come out, and what you see here is I put these together with channels because we actually have the ability through the option tools to create channels. I'm going to show you how to do this in just a moment for those of you that don't know how. But you can, with one click of your mouse, be able to overlay channels, long, intermediate, and short term, and look for channel consolidations or even where channels come together. Netflix, we had a move up this area right here, this big candle that you see that happened. That was earnings report. Dropped down to very close to around, let's call it below 350. All right. And then it actually rallied all the way up into the close to around 380. Now, we haven't seen that. We haven't seen a high from that, but we have kicked off and seen a low potentially. And so this tells me there's more move to the downside to be had. I think round number 300 is a good area for support. Then we're seeing areas of like 290, all right, 270. And then all the way back here at the end, at the beginning of February, at around $235. That's hard to imagine, but it was also hard to imagine to see what's going on with the most of the FANG stocks over the course of the last couple of days. Let me run over to the tools real quick, and I'm going to go ahead and look at from where we were, all right, to where we are. So let's factor in what's happened this week. So I'm going to stock charts, and what I'm doing to get those channels, everyone, is I am going in and I am using the stock. I'm going to put in the symbol. So I'm going to put in NFLX. I can hit update, and I'm going to just see what I have now. So this is going to show me where we are now, and then I'm going to look at chart peaks. Stock peaks are where support and resistance levels are based on how far this has moved back, and it's based on the close of the day, not the highs or the lows. So we know we have a stock chart peak close to 420, but we've got support again at 330 and 320, and then they start to kick in 280, 250, and then all the way down here looking at the beginning of the year, about 185, 190. Now let's put in the channels. So to put the channels in is very simple. Come down here to where it says channel test. Make sure you have up, down, and sideways clicked. You can use the default settings that are in here. They're already set in there at not as fixed channels, but what we call find channels. So it'll find the channels, and as you can see, those channels have not changed in the last couple of days with Netflix. Okay, so now what I want to do is I want to show you the other ones that we have in here. Let's go ahead and move to the next channel we were looking at, or next stock, which was Google. Google came out, it exceeded on all ends, revenue, earnings, etc., and it popped. And as you can see, it popped immediately, and it gave back a little bit, but it inched higher. All right, not today, as it finally suffered a pullback along with a lot of the rest of tech. Right, so as you're looking at Google, Google is not going to change either. Its channels are pretty much straight up until we break through this equilibrium. All right, so when you look at a channel, it has three spots on our tools. It has the resistance side, it has the support side, and it has what we call the mid or the equilibrium side. If we break through that equilibrium side, we could see the intermediate or even short-term channel project something other than up. Facebook. All right, here's the black swan of FANG. So I call it the black swan of FANG because nobody, and I'm going to include myself in this, nobody saw this coming. All right, nobody saw Facebook go from an all-time high of $217 to the very next day going down to 170. I mean, that was just something that I mean, and if you're watching this moment by moment, the gas came out of Facebook not when the earnings report came out, but when the COO started talking about future, I mean, just literally handed the bears the stock on a silver platter when they said, oh, our margins are dropping from 60 to 30. That's all that had to be said. And then boom, we were trading at 170 and below. And that was in the overnight markets, and didn't really make up ground from then. So if we were to look at Facebook today, since that happened, we'll type it in. We'll get the now in order to get the stress test, I've got to go out there and I've got to test this correctly. Now, if I go to latest, this will bring this out, and it shows me that Facebook has moved outside of those lows and started to move even lower, right? So I actually see about one. If you look at what happened on the move down, all right, it looks like this is a potential bottom area around 165. All right, from there, then we start looking at round numbers like 150, which is the low that you see that happened during the Cambridge Analytica scandal. All right, but again, to stress test this, click on channel test, and then you start to see it. And you can see what happened before this happened. This was all systems go. Now the channels, the small channel is actually starting to turn, all right? And we won't get a short-term channel for a few more days, but we'll probably end up getting a short-term channel that's projecting, at least for the short term, moves to the downside, all right? Finally, you look at Amazon. Amazon, again, it really did save FANG from being disastrous, last week and then into today. But it too had a jump up, and then it just had a pullback day for the rest of the day. Made an all-time high, but it didn't close on an all-time high. And you can see it too has channels that are moving higher, but it too also has support points, and those support points on this particular chart are around 1650. That's a lot away from where we are. But then you look at 1550 and all the way down here at 1350 based on these lows. So let's go take a look one more time at Amazon. All right, so we've looked at Netflix, Google, Facebook. Here's Amazon. And again, I'm looking at the latest date. So come down to the channels and again, hit channel test. And it's going to factor those channels in for you. But look what happened today, 1779. All right, we were at 1870 when the earnings report came out yesterday, Friday morning. After the earnings report came out, we've already dropped 100 points inside of just 2 days, and that was on a blowout quarter. So there is a kink in the armor when it comes to these, and so my big takeaway. And by the way, let's just look at the overall markets. So DIA, all right, Dow Jones Industrial Average. This one is probably the darling of the bunch, even though we haven't seen the highs that have occurred back in January. If we run the channel test, let's run the channel test. Let's see what it looks like. All right, it's running the channel test based on the last couple months, but all systems seem to be go. Although today we did start out nice and just kind of fell apart. And I think the Dow fell in sympathy to what was going on the tech side. You'll see things get worse in a moment here. SPY. So Dow was down, fractionally. SPY was down even more fractionally. All right, let's go look at the channel test on the S&P and see if anything's changed. It's still up, but we're getting into some critical area here where these equilibrium channels are possibly going to be breached. The long term is breached already. If the intermediate term is breached, it's going to change this pattern. But then there was the Qs, and the Qs got hurt the most again today. All right, had a bigger drop than the others. As you can see, still, just a few days ago, we're hitting all-time highs, and we've come back. And this pullback here is really hard. It's really hard to look at that pullback and see the magnitude of that loss in just the Qs. You have to look in the tech stocks that really got hit hard. Amazon was one of them. Baidu. I mean, even Apple had a tough day today too. But the Qs definitely, as a group, had it the worst. Let's just check a channel test again. And what I'm doing is just simply bringing up my chart or my stock, and I'm coming down here where it says channel test, and I'm just making sure all of these up, down, and sideways projections are there. And then the default settings, which my programmers and I have created for our optimal channels, are there for all of you to use. Okay. All right. So and to end this part, and really kind of turn it over to Jeff and start talking about delta neutral trading, is I want to end with at least this part of the webinar with what I learned from Q2. All right, all in all, FANG just made everyone, including me, realize stocks can't keep going in one direction without even a little pullback. Now, I don't trade on I think something's going up or I think something's going down. All right, I'm a rules-based trader, but a lot of my rules-based trades in FANG were simply saying it's going higher, it's going higher, it's going higher. All right, but safety, and those of you that know me know this, safety is in what happens before earnings. All right, risk is what happens after earnings. And number two, if the possibility that FANG is moving lower, the entire tech sector could suffer as well. We're seeing that happening right now. Right? And let me add on number two for a moment. So what do I think is going to happen with this? Well, if you look at the August money calendar, let's go take a look at it real quick because it helps give me an idea where things potentially are going to go. Let's go down to premium. Not premium. I want to go down here. We're gonna hop in the premium tool section for a moment or two tonight. But if I go over to money calendar, now this is July. All right, because we're still in the last couple of days of July, but take a look. Now, July was in like a lion. I mean, just bullish all the way into almost the end of the third week. Then look what happened. All right, this is the money calendar predicted that we were going to get volatility. All right, and that's exactly what happened. We ended up getting it about a week late. All right, so let's look and see what August tells us. So August for stocks is really a lot of the same. This is this week. Here's next week. Here is the third Friday of August, the third week of August. We don't start getting bullish again until the 20th. So we have 3 weeks of still a lot of bearishness, a lot of uncertainty, and finally start to climb out of it, I think toward the week of the 17th. So to me, what am I doing? If it's bullish, I'm tightening up my spreads, which means if it's bullish and I want to get into it, I'm not overpaying for it. In fact, I might price myself under thinking the market's going to come to me. But in about 3 weeks, I'm planning on changing that and starting to put a little bit more into the market on the bullish side here. The other thing is that if you want to take a longer term approach to it, sell in May and go away, I think got a little bit late because the way we're looking at it is it's almost sell in July and go away. Sell at the end of July and go away, which could change to sell in July and start trading delta neutral. Okay, and at that point, I want to turn it over to Jeff for something that we like to call calendar mastery. So Jeff, are you ready to go?
I'm ready to go, Tom.
Awesome. So I will be putting this over to you right now. Just looking for you. There you are. Wonderful. We got so many people in here, or some of our tool members in here. So let's make you the presenter, and you now have the con.
All right, so let me just make sure I get the right screen up here, and my presentation will be popping up here in 1 second. Technology.
Yep. I see. There we go. Delta neutral trading calendar spreads.
All right. Very good.
So I am going at this point, close my mouth, open my ears, like everybody else. And by the way, everyone, we are going to be doing a bit of Q&A here afterwards. I mean, I see one of you asked, what is a FANG stock? Okay, FANG is the acronym for Facebook, Apple, Netflix, and Google. And that's exactly what we just talked about here in just the last 15 minutes or so. All right, so at this point, the only other question I have that I just want to answer real quick is someone's asking about channels. Are they similar to standard deviation values? And Lewis, you're absolutely right. As you can tell, the channels that we're using were not fixed channels. They're based on standard deviations from a specified value of the chart. All right. So that point, thank you for the questions. And if you have questions for Jeff as he's discussing this, feel free to ask and put them in the Q&A box, and we will do a Q&A session with Jeff as soon as he's finished. So Jeff, it's all yours.
Very good. Thanks, Tom. In fact, speaking of FANG stocks, one in particular, Apple, back in the day, we traded calendar spreads on Apple like crazy at $15 a share. That stock traded in a $1 range. I'm not kidding you, for 2 years.
Was
And
that like 2000? Was that like 2001 to 2003?
yeah, it was back in the early 2000s. I mean, it was
That was
printing
before.
money.
That was before iPod, wasn't it? Just
Yeah, it was
before the
back.
pod.
I mean, I wish I would have caught the rest of the run, but it was good
Yeah.
while it lasted. But anyway, well, let's just jump into this. So, hello everyone. This is me, Jeffrey Beamer, sitting in my office. I do like to pay attention to what's going on in the world around me, so I have to have a lot of screens. But as Tom mentioned, I am a professional money manager. I've been managing money for people for a couple of decades now, and I won't run through this all, but we'll learn a little bit more about me for those of you that join us in our upcoming class. But I definitely have some skin on the wall when it comes to trading in the investment markets. But you can just see here a little bit about me and about my past. And I've just been really active in the industry, really in touch with what's going on for a long time now. And boy, do I have stories, and we're going to share some of those stories as we go through our class. But right now, my former firm, Sigma, was acquired by a Dallas company called McElhaney Sheffield last year, and so right now I'm an investment manager for them. I manage a couple $100 million for McElhaney Sheffield. Their assets are a little over $500 million. So, we apply a lot of what we do here, what we show you, and what we try to teach you, we apply in real life when we manage money. So let's get into delta neutral trading, because that's why I'm here, and that's what Tom, what Tom wanted me to talk a little bit about. And we're going to start with calendar spreads, because they're probably one of my favorite strategies, because they're so flexible, they're so easy to make adjustments, because you're dealing with just two legs, a buy and a sell leg. And if you're not familiar with what a calendar spread is, which I think you probably are, we're going to touch on that here as we go through the next few minutes. All right, so let's talk about why now. Why would we be talking about calendar spreads now? Well, part of it has to do with where we are with volatility. When the VIX gets down here, for me, it's anything really below 15. That's my personal kind of, my personal flag for doing trades like a calendar spread, because implied volatility is an important criteria. Now, this is something that you might want to take a note on. When we deal with calendar spreads, implied volatility is critically important. And a calendar spread benefits from an increase in implied volatility, not from a decrease. So if implied volatility is over here trading around 25 or even 20, you really have to be careful and pick your spots if you're going to do anything like a calendar spread. Okay, but when it drops down, and you could see last year, going into the fall, September, October, man, we were just at 9 and 10 and 9 and 10, and it was just a really good market for calendar spreads. And so now we're kind of getting back down there. This snapshot was taken earlier today, about midday of trading today. So you can see the VIX is trading at 1351 at the time that I snapped this picture. All right, so let's move on here. What we're going to talk about over the next few minutes is really just a brief overview of delta neutral trading, and really the basics of a calendar spread, what I look for, what you might want to look for when trading a calendar spread, and really how to quickly become an expert at the strategy. This is just one strategy of many. If you what I like to do is look at a chart and form an opinion of what I think about a stock is doing, or an ETF, and then reach into my strategy toolbox and pull out a strategy. Meaning, is it going to be a calendar spread? Is it going to be an iron condor? Is it going to be just something directional like a vertical spread? What type of strategy do I want to apply to the chart that I'm looking at, or that we're interested in? Okay, and so just look at it this way, that a calendar spread is just nothing more than like a hammer or a screwdriver or some tool in your toolbox. All right, there are times when maybe even one of our favorite stocks gets range bound or trades in a tight channel, and a calendar spread might be the exact strategy that we want to trade with. So a brief overview of delta neutral trading. This is something that's unique to the securities market. There is no other industry out there where you can make money from trading in a delta neutral form. Think about it for just a moment. If you were buying and selling of real estate, well, if you bought a house and then you sold the same house, well, now you're neutral, but you have no inventory, right? If you bought a house in one part of town and sold a house in another part of town, well, you're still just you have one house, still. So there's really no other sector. It's really unique to the securities industry, specifically the options industry. And I'll talk a little bit about that in our class, but it really has to do with theta decay and the fact that options lose their value over time. They are a time-sensitive instrument. All right. So delta neutral trading incorporates strategies used when markets or an underlying security trade in a sideways or range-bound manner. Now, keep in mind what a range-bound manner is. Range-bound doesn't necessarily mean sideways. Range-bound could be moving higher or moving lower, as you'll see here in just a few moments. All right, so let's go ahead and take a look at some charts, and you'll get an idea of what I'm referring to. So here's a 1 year chart of the SPDR Index Trust. Now, Tom just showed you a chart, and let me just tell you, those channels that appear that Tom was showing you, golly, those are so awesome. Those make charting so easy, especially when you trade in some of the forms that we trade. All right, but I wanted to just throw up a much longer term kind of channel. You'll see here a much longer time frame. Really, it's since the beginning of the year, the S&P has been range bound. Now this is about an 8 to 9% range, but Tom mentioned there was a little shorter. He showed some channels on a shorter term time frame, and yes, you could probably draw some lines that go from one end up to the other, and there's some shorter term channels, right? All right, so there's a channel right there that we're currently in. So it kind of, you got to pick your spots and define your targets. But anytime you can use this technique. Look back at October, November. Look how tight we were in the channel. Okay, moving higher. Now let me tell you a little secret about this. When you draw a parallel lines like this, or you have a channel that extends 2 to 3 months, this is where I like to have a lot of blank space over to the right-hand side of my charts, okay? Because that way I can envision where price is gonna go. And what I mean by that is if you took kind of the median line of the channel, the middle of the channel, and forecast it forward, okay, sometimes you can actually pick a target. For example, like at some point in time, we would think that maybe by February, for example, the stock might be around $270. Well, as you can see here in this case, it wasn't for SPDR. It really rallied up. You have an even tighter compact channel right here as it moves up. And let me just tell you how easy it is to just draw a straight line. When you get a channel like you're seeing here, you just draw a straight line underneath. And when it breaks that line, man, it's time to hedge, time to collar your stocks, time to put on extra puts, bear put spreads. When you draw that line in your sand, when you see a chart like that, it's almost like shooting fish in a barrel. But where are we now? Well, on the broader market. In fact, let me go to an even bigger chart. This is a 5-year chart of the SPDR, and you can see the little year-to-date channel that we have up here. But look at all these other trends, okay? You have from literally the middle part of 2016 to the almost the beginning of 2018. Look at that, just nice tight channel that the S&P was in. And then you have a period of consolidation prior to that, from 015 through 016. Yes, there was some volatility here. This isn't the tightest of a sideways channel, all right? But even before that, you had this nice little tight channel moving higher. So really, you can get a good feel for the market and good feel for your underlying security just by drawing trend lines and channels, all right? You don't need all these other indicators, Bollinger Bands and moving averages, and you end up putting so much garbage on your chart you can't even see price. Just draw basics, and it'll help immensely. All right, so let's look at some other stocks here. Okay, so this is current as of earlier today. I like just using the latest data that I can. Okay, that was here's Newfield Exploration, and I'm sorry my lines aren't the straightest when I draw here, but I'm not an expert at the mouse. But you can just see, you draw a horizontal line over the bottom and the top, and there's your channel. Okay, trading kind of sideways. One important thing to notice, anytime that you look at a chart, many charting packages automatically adjust your chart, so it makes them look all kind of the same. But what I want to caution you about is always check the price scaling over to either the left or right. Notice how this particular stock is in a $2 range, okay? In a $2 range. If you were to compare that to the previous slide, look at the scaling here. You're in $10 increments on this scaling, on this 5-year chart, okay? Prior to that, here you have a scaling in a $5 range. So you'll notice how the chart is kind of auto scaling this. Now, some charting packages allow you to automatically adjust that scaling. And when I do have a chart that I can adjust that, I always tend to adjust down to $5 increments, because a lot of stocks still to this day have options traded every $5. Not every stock or ETF have options price, have strikes at every single dollar. All right, and that's why I like to do that. All right, so here's another stock in a different industry. Here we have Procter and Gamble, and I'm sure you guys have some experience, and you can just see what's going on here. You have a nice channel that Procter and Gamble is in, except this channel is going from the lower left to the upper right. Now, can you envision, here we are at the end of July, if we just take the middle of this and forecast out to maybe the middle of August or the end of August, where we might be? Well, look at your scaling here on the right-hand side. You can see that we're in $2 increments. So this stock is only moving a few dollars every month. What would that mean to you a month from now? If the stock stayed within this channel, where would this stock be? Well, it's going to be between $82 and $84. It's really that simple. Now, Procter & Gamble has earnings coming up. Earnings kind of always throw a wrench in the works, just to kind of warn you. But that's why this works especially well on ETFs. All right. But we're here to talk about calendars, and what I am referring here on Procter & Gamble, for example, is what if I were to put a calendar spread up at the $82 level? Well, the stock's trading just above 80. What if the stock just walked right up into the body of my calendar spread at $82? All right. Well, what if your prognosis was bearish and you thought it would drop to 75? Could you put a calendar spread down at the 75 level? Yeah, you can. It's based upon your own analysis and your own prognostication of what you think the stock is going to do. All right, let's take a look at one more here. This is H&E Equipment Services. Look at this stock. The scaling here is in $2 increments on the right-hand side. You can see that this stock, yes, there are a few times when there's a little bit of blip here, but otherwise, if you were kind of to take the median here, this thing consistently trades right around that $38 level. Okay, so between 36 and 40. This thing has been trading there for months and months. All right, so these are the types of stocks that we search for. These are the types of stocks that give us a great opportunity and increase our probabilities of success. So we like these. And the thing is that there are almost always, now I can't say always, but I can use almost always a good calendar candidate. Now, the times that they're not, okay, are, for example, there were calendars aplenty up until about 2007. So from 2001 to 2007, I mean, there were, you didn't have enough money to trade all the great calendars out there. Well, then we had volatility pick up, and then 2008 came, and everything correlated to one, and just, we had the big correction, as everybody knows, and then the incredible rally coming out of 08 as we went through 09, 10, 11, 12, just the incredible rally. Yeah, then calendars were a little bit of a challenge, okay? But now things have kind of settled down, different sectors have rotated. Sometimes it's consumer discretionary. You can find a ton of candidates there. Sometimes it's maybe biotech, which is kind of funny because those are some of the most volatile, biotech. But you get my drift, that sectors sometimes go through a period of consolidation, and we just through our processes, we're always able to identify those and find good candidates. So let's talk about the basics of a calendar spread. Okay, so we've thrown this word around. If you never traded one, never really thought about trading one, this is also known as a time spread. So I remember this is the way I was taught. Was these were called time spreads. And then George and Tom back in the day were up back in around 97, 98, we're up on stage talking about calendar spreads. And I'm like, oh, what are they talking about? Oh, time spreads, it was kind of funny. Took me a little bit to remember that it's one and the same. All right, so calendar spreads take advantage of an underlying security which is trending sideways or in a range-bound action, okay? This includes stocks, ETFs, and futures. Now, the basics of a calendar spread, we do these at a debit, which creates an attractive limited risk strategy. Now, let me tell you something. Tom mentioned earlier about finding trades under $500. Let me tell you, I'm finding trades right now for not only under $100, not only under $75, but well under $50. I'm finding trades for $17, $35, $40. They are all over the place and they're dirt cheap. All right. And the great thing about this is you can really control your level of risk when we find these types of trades. All right. So a calendar spread is constructed by the purchase and sale of an equal number of either calls for a call calendar spread or of puts for a put calendar spreads. Okay, so it's done on the same underlying security at the same strike price, but it has different expiration dates. Okay, so calendar spread is created by purchasing a longer term option. Okay, so look at it this way. If you bought, so here we are, June 30th. If you bought something out in October, all right, and you wanted to say finance that, say you had a bullish opinion of a stock, but you didn't think it was going to move for a while, well, you could go ahead and buy an at the money. We'll use at the money for an example right now. An at the money call out in October, okay? But right now, if you thought it was going to trade sideways, you could sell an August option to help finance that purchase, okay? It's like a renter, okay? You own a piece of property and you have this renter that is just renting from you and paying you a premium, okay? So when August expires, could you roll to September and sell a September option? Absolutely. You can sell a September option because you still have that October option, and this is how we make money on these particular trades. All right, so let's look at a current example. So this is Freeport-McMoRan. Now notice again, let me stress, look at your scale over on the right-hand side. This chart is scaling this in $1 increments. So don't let this huge drop fool you, okay? That drop was $4, okay? Imagine what a $4 drop on Amazon would look like. It would barely show up on the chart, all right? So you got to be careful with your scaling, okay? But this thing is trading in a $1 increment, all right? So let me give you an example of what a calendar spread on something like Freeport would look like. All right, so here's an example, $17 trade. See this right here, $17. All right, so this is a calendar spread. We went out and bought a Freeport-McMoRan 16 put that expires September 21st, okay, and then sold a 16 strike put that expires on August 31st. Now, this is all the immediately a little might raise a few question marks. Can you trade a weekly option with a natural option? And the answer is yes. You know, it's the same stock, Freeport-McMoRan, same strike, 16 strike put. You know, I could go out and sell the first week of September, sell the second week of September against this September 21 expiration. Okay, so I could get 3 rolls in here and try to make money on this trade. So let's break this down a little bit. So our debit here is $17.17 to make 35 cents. Now that might not seem like a lot, but you got to remember that's a 210% potential return. Okay, now let's look at a risk graph real quick, and I might come back to this, what I'm showing you. So here's the risk graph. All right. Now you'll notice I have this in the modern view. Okay, so stock price is going to go right into the body of my graph here. Okay, so we want this thing to be at $16. Okay, in 32 days. Okay. In 32 days, I want this thing to be right here. Now, you'll notice a unique characteristic of calendars is the witch's hat. All right. Now the witch's hat here is laying on its side, so it gets into this little peak here. So ideally, what you probably want to do is be out, you know, somewhere when it's you got about 11 days left, because you still got a little bit of width here for the stock to move around. All right. So in effect, you know, we're looking at maybe doubling our money on this. Okay. So you can see our profit down here is $10 here, $20 here. So if I could double my money on this, I'd be very happy. Okay. But double my money. Okay. Turn $100 into 2, turn $1,000 into 2, et cetera, and so on. All right, and Freeport's a very liquid stock. There are a lot of options traded on it. All right, so let me pause right there. Tom, any questions so far on? I've been just rattling on. I get so excited about this.
Yeah, you got a few.
I should have stopped earlier.
I mean, other than you have a couple of people that couldn't hear you in the beginning, but I think the sound came back right away.
Okay.
Jeff, can a channel be too wide for a calendar trade?
Yes, it can be. Now it really depends on. Can you see here on this chart, everybody, the light blue? I guess that's light blue lines here and here. These are our break evens in the trade, right? Now you can see that this stock, this is why these charts are so valuable. You can see that this stock has traded outside, above, and around the break evens of this trade. So this would be an example of a stock that, even though is in a $1 range, okay, that is a little volatile for this potential candidate. Now, if my break evens, if I was able to get my break evens to a point where they were, say, way out, if I can get my pen to work here. Okay, here we go. If my break evens were down here and up, oops, say up here, I couldn't even see my little. So if the stock were, if those were my break evens and they were contained within the stock action was contained within my break evens, then it would make me a lot more comfortable. So how would I manage? So how would I manage this? For a stock like this, if I were to seriously consider this trade, what I'd like for everybody to do is to paper trade this. You know, just record down what the trade is here. It's buying the September 2021 expiration 16 strike put and selling the August 31 16 strike put, and paper trade it. And you know, I will caution you, this meets probably 90% of my criteria, not quite 100%. Maybe 80 to 90% meets my criteria, which we'll cover extensively in class. And there's a couple things that I look for, and this stock right now, this particular trade doesn't have two important ones. Okay, but what is my prognosis for the stock? Is it going to be at 16, you know, in 32 days? Well, there's a good chance. It's been there a bunch. Tom, any other related to this kind of topic?
Nope, that's it for now.
Okay, all right. So lastly, let me just show you probably one of the most important parts of the graph. And this is the implied volatility chart on our trade. So the Freeport-McMoRan trade, you can see that that implied volatility has just really crushed here. Obviously, post earnings. Okay, you can see.
I got two more, Jeff.
Okay,
Sorry to interrupt you. Yeah, they just popped up here right after I said there were none. Are the red, blue, and green lines the standard deviation lines? That was one of them.
Are we talking these red, blue, and green lines? What do you think they're talking about, Tom?
Well, I think each. I mean, I think you probably need to answer each. So that's time to expiration.
Right. So here on these, as far as the red, blue, and green here we have today. Okay. Then the blue is 1/3 time to expiration. Then the green is 2/3 time to expiration. And then obviously the black is at expiration. That's what these lines represent. Okay, so and these lines will move every day.
And that's what was that was the question. And the second one was why puts rather than calls when you're putting together counter spreads?
Why puts rather than calls? Well, guess what, folks? We probably want to look at both. In fact, you know, let me come back to that real in just a second. Let me finish up with this screen, and I'll show you why maybe puts instead of calls. But the short answer is you always want to look at both. Okay, and the reason you want to look at both is every now and then calls will give you, let's say, so here's our put trade at 17 cents, right? If the call version of this trade was at 19 cents, which one would we take? Well, I would probably take the 19-cent one. I mean, the 17-cent one. It's a little cheaper, right? The 19-cent one is more expensive. Okay, so it would be $2 more expensive, and you're like, well, $2, you know, what's $2? Well, that's 10% of your, that's 10% of that debit, right? So, yeah, that's usually the difference, and that comes in from the skew that exists in options. Another reason puts are nice are that if you kind of get lost in your trade and somehow you get assigned on your short option, meaning your short option goes in the money and all of a sudden you are assigned, with puts you're now long stock, and people are just more experienced and comfortable with being long stock. Okay, doesn't mean that call counters are bad to do. I do them all the time, but really it comes down to pricing. Okay, and we'll really get into that in class. Is you always look at the opposite trade. So I chose the 16 puts here. The 16 calls were probably at 18 or 19 cents. They were probably a little bit more expensive and just didn't give me the value. That's why here. So let me just kind of circle back, and this is my last slide, Tom. If I have a moment, if I've got like 5 minutes, I'll jump into Tom's tools and show kind of one more thing there.
Absolutely. Yeah, you got
Okay.
time.
All right. So here we have the implied volatility chart, and as I mentioned, we have a volatility crush. You can see this blue line that's kind of zipping across here that touches this. This should be touching the option that we are short. Okay. The option that we're short, that's the nearer term to expiration option. Okay. So the closest option to expiration is where this line should be touching. All right. And you'll notice here, I didn't show it in this picture, but this risk graph over here on the right, there is a break even. There is a break even where this black line will cross this zero line, and it happens to be way below, down around $20, or around, not $20, but 20% on implied volatility. Okay, the bottom line is we are really looking good as it relates to implied volatility on this trade, because we're near the bottom of where historically implied volatility has been. You're going to become an expert really quick at reading this chart and knowing its impact on your trade. Okay, and where its impact is, just so you know, is right here at where it says Vega. Okay, so 54 cents. And I will describe how to read that and how to calculate that in the class. Okay, we're going to go over the importance of that. All right, so this is my last slide. Let me jump over to the tools here real quick. Discard that. Okay, all right, so let me just come up here and show you. So if I go to some searches here, we have our calendar spread searches here, right? Now, I just want to show you real quick the wizard here. All right, look at all these that we get to play with in our class. Okay, at the money put calendars, at the money call calendars. B2B means back to back, where the expirations are one after the other. So in the case of normal options, we'd sell in August and buy September. Okay, sell in August, buy September. Sell in October, buy in November. Back to back, like that. Now, if they're weeklies, it would be, sell this upcoming Friday and then buy the following Friday, right? That's back to back. All right. So look at this, directional calendars, bullish, bearish. Okay. Diagonals. What does diagonal calendars mean? Meaning, boys and girls, there's all sorts of things we can do with calendars, and we're going to get really creative and have some real fun with these. But let's just talk about the basics for just a moment. How do you find a good calendar? Well, let me give you a little bit, just a little hint here. All right. So here in your tools, you can go over here to Stock Rankers. Okay. Under Stocks, just go to Stock Rankers. Come over here to Channel Finder. Click on Channel Finder. All right. Now, lists. Lists are one of the most important critical steps in finding opportunities. Tom mentioned FANG stocks. That's a list. Facebook, Apple, Netflix, Google. That's a list. Okay. S&P 500 is a list. Okay. Russell 3000 is a list. All right. So if you don't know, there are some default lists, or you should know. There's all sorts of default lists that are, adjusted daily back here. So I'm just going to choose S&P 500 optional. Okay. So here we have optional stocks on the S&P 500. I could search that list. Okay. Or I could go to, here's a hint, quiet statistical volatility stocks. All right, so you can see my wizard here. It says best sideways channel. All right, so let's search this. Okay, so here I'm searching this list. It's going to take just a second to calculate and populate. Okay, so here's my list. It came up with 249 stocks in our list. Now, you might be wondering, okay, what do these stocks look like? Well, you'll notice here in the middle, there's this word called pick that's highlighted, that's bolded. And if you just click on pick, then you got a picture of the stock that pops up for you to look at. So remember, always look at your scaling. So this is in $2 increments. So I just know that this thing's not really a huge mover. It's just moving a few bucks every week. Okay, so that's on CLB. Let's just, you know, here's CM. You know, you can see this was consolidating. Look at your scaling here, $1 increments. Okay, did catch a bit of a bid here, ran out. Okay, so it might not be a candidate for us. Oh, here's Big Blue, IBM. Let's take a look at what it's been doing. Okay, your scaling is in $2 increments, and this stock's just been hovering around the 142 to 146 level. There might be some opportunity there for a calendar, or, you know, something else that's delta neutral. So I've got all these stocks. I've just narrowed down the S&P 500 probably stocks. Most of these stocks are probably in the S&P 500. I narrowed them down by looking at the quiet statistical volatility, meaning stocks that just have been quiet historically from price movement, and I narrowed them down from 500 to 249. What if there was a next step of narrowing that list from 249 down to 100? And then what if we narrowed down, or otherwise called filtered, what if we filtered that list from 100 down to the top 50 candidates? And from there, we just chose the cream of the crop. All right, well, that's the process. And we're going to go through that process over and over and over again and drive home the point that creating a good list is just like any other list: garbage in, garbage out, quality in, quality out. And that's what we're going to do. Tom, other questions? Tom, you there? I'll keep going then.
I'm
All right.
sorry, I'm talking. The mute button was on. I was talking. So
I'll just
yeah,
keep going.
I feel like Jay for a moment because he does that all the time, not me. Vladimir's asking, how do you manage or adjust a trade when the underlying stock goes against you by going up or down too much?
Well, that's a good question, and that's something we're going to cover in class. The first part of that answer is, what's your prognosis? Okay, if you think the stock is going to come back, again, think, not hope. Don't hope. Hope is not a method. But if you think it's going to come back because of technicals, maybe your fundamental, then stick with it. Okay. Here's a point that I'll tell everybody, and I will reinforce this time and time again. Okay. I don't use stops. After getting burned in 1987 and learning that stops don't work, have never used them since, never will again. How you manage your risk is by how much dollars you commit to your trade. So for example, and this goes into the adjustment question, I just took a little left-hand turn to get there. Okay, so if a stock meets 9 out of the 10 criteria, if I have 10 criteria and the stock meets 9 out of the 10, hey, that's 90%. I'll probably put some money to this. Okay, so if you're used to putting $1,000 to investment into your trade, but you only want to risk half of it, let me tell you, your performance will most likely improve if you just go ahead and put $500 there, because that's what you were going to risk anyway, and let it go to expiration. If you use that technique, it does wonders for you, because it takes emotion out of play. Okay, it takes your trigger happy finger out of play, because your first impressed thought might be, to the person that asked this question, what happens when it moves out of my range and starts moving against me? Well, for me, I just might let it go, because hey, this is what I had invested in the trade. This is what I was going to risk. You know what? 9 out of 10 times it comes back. But that's me. Okay. You got to go with what you're comfortable with. So there are times, let me summarize that question. There are times when we do adjust, okay? If you have time to adjust, timing is one of the critical components. How much time do you have in that long option? If you've got a couple months, we're probably going to adjust. If you have a week, not much you can probably do. So it all depends on time and prognosis is kind of the simple answer there.
Okay. Let's see what I have. The graph looks a lot like a butterfly. Can you explain that?
Sure. One thing to look at, in fact, let me do this without trying to get my presentation back up. Let me just go to, let me just kind of create a trade here real quick. What do we have? Spider. All right, so I'll just build some random trade here. All right, let me show you a little secret here. All right, so we'll do an at the money. Here, I'll do calls for all of you that don't think we do calls. Okay, so we'll sell one of these at the monies. That was the 279s, and then we'll go out here and we'll buy this. Okay, all right, so we'll take a look at the risk graph. Now, it looks like a butterfly. Now, you'll notice here that this is 2 legs rather than 3 legs. Okay, now butterfly is buy 1, sell 2, buy 1. Okay, this is buy 1, sell 1. So it's much simpler. Now, it's not that and trust me, I love butterflies. I do a lot of butterflies. But the calendar, you can tell, always has the curve. Okay? You see the curve in the risk graph here? Anytime you see a curve rather than right angles, you know that there's time involved. You know that there's a difference in time between your buy leg and your sell leg. All right? A butterfly, if you were to build a butterfly, and let's see here, let me just build. So we'll do -2, -2, and we'll buy 1. We went 5, 284. Okay. All right, so we just built a butterfly really quick. You'll notice here the right angles. Oops, see, that's what I get. Oh, I didn't do my buy leg. See, that's what happens in real time. You just kind of get excited. And what did I do here? Oh, 274, missed that one. Okay, try that. Okay, so you can see here the difference. You can see the right angles here. This is the butterfly, and then your curved lines are your calendar. That's the difference. What else there, Tom?
Last question I got for you. What's your exit strategy on calendars? I know that's a loaded one.
Here is a pretty simple answer. Okay. First of all, see the max profit here in this particular calendar? Okay, it's 272. Target 80% of your maximum reward. Okay, 80% of your maximum reward. Okay, that would be around $215 roughly. 200. So I'm not trying for that 272 because I got to nail it at expiration. Okay. Also, it depends on velocity to that. For example, I can see here that my maximum profit to risk is 77%, meaning I can't double my money. I can only make a 77% return instead of a 100% return. If within a few days, all of a sudden I notice that I'm up $100 in this trade, in this particular trade, if I was up $100 within a couple of days, I'm out. I'm taking that money and I'm running. And the reason why is because I still would have so much time left. You can see the days to expiration. I would have So let's say in the next 5 days I made $100 of that 272. Well, then I'd still have 30 days, 29 to 30 days of waiting for the rest of that $170. I'm out. Okay, so it's one of two things. It's either a quick significant profit or 80% of the possible maximum reward. Now, I've been known, you'll see here, we'll get into this a little bit in the class, but you'll notice up here you have these Greeks, and I'm specifically going to look at gamma and theta. You'll see that gamma is negative and theta is positive. Those numbers get bigger as you get closer to expiration. It's called the gamma theta war. I like playing the gamma theta war because it adds a level of excitement to my trading, but a lot of people don't. Okay, a lot of people don't, and I'll explain what that gamma theta relationship is. So we cover a lot in our upcoming class, lots of good stuff, and there's always some good solid trades that we'll be able to find as we go through the course.
Jeff, I'm going to sneak one more question into you.
Fire away.
Paul is asking, what determines if you roll a calendar over? And before you answer that, let me let everyone know that I put Jeff's handouts. Jeff's slides are actually in the handout section. So within the GoToWebinar panel that you have, you can download his handouts. I'll be including them in the email that goes out following the live event. So Jeff, again, what determines if you roll a calendar over?
What determines really is your prognosis. So let's say you're successful in your calendar, okay? Things are going well. The underlying security is right where you want it to be. And you have, let's see the option that we sold here. Let me make it easier. If you guys don't do this, take this step. Whenever you build a trade, go into edit. You'll see here leg color. Do yourself a favor and start coloring your legs. I always color my buys green and usually anything that I sell red because I need to be aware of what my obligations are. So my shorts are always red. All right. You'll notice here that this 279 call, we're selling for $475. If all of a sudden I look up and it's worth $1 now, okay, and we're still right around this 279, 280 level, what I'm going to do is buy this September 7 expiration to close, and then I will sell either the next series or I'll look for another opportunity. And what I mean by that is you can see here that of the expiration months available, we sold the September 7th and bought the November 16th. So if I buy the September 7th to close, you can see the next one available is the 21st. Okay. If that one's successful, then I could roll to the 28th. If that one's successful, I could roll to October's. Okay. Now we will get some additional weeks added here as we go through through time, but you can see what's available right now. I have after this leg, I have 1, 2, 3 different rolls that I can make to bring in additional income to pay. Again, to pay for, that's the butterfly, sorry, here's the calendar, to pay for this call that I bought for $8.28. Okay, if that was my trade. By the way, folks, this is not, if you wanted to track this, this is the way most people build a calendar. And let me tell you, this is not the way to do it because there's already several things wrong with this trade. Okay, one has to do with implied volatility, one has to do with, with what price is doing, one has to do with the width of the bands here. There's all sorts of problems. I just built this as an example for you guys to take a look at. But my point here is I bought this 279 call for $8. I want to help finance it, so I sold this 279 in September for $475. that reduced my debit from $8.28 to $3.53. That's a significant reduction in cost to my trade.
And Jeff, the biggest question I had, and I saved it, is that I'm getting this quite a bit, is that what is this class that you're referring to? And maybe that's where I'll take over. You keep saying,
sorry, I let the cat out of the bag, Tom. I'm sorry. I let the cat out of the bag.
What kind of class? So it's actually a series of classes. And let me just show you, just spend just a couple minutes talking about what Jeff is going to be doing inside of about 10 days. So Jeff is offering, and this is the very first time that we've offered Jeff up outside of our partner program. First of all, those of you that are partners on here, if you're a gold partner or a platinum partner and you know who you are, you will be getting a welcome letter from Jeff and I tomorrow with the information on when Calendar Mastery Series starts, which is actually next Wednesday. I believe that's August the 6th, or 8th? Is that right, Jeff?
That's right, a week from Wednesday.
And so we'll be giving you guys the invitations. You'll be getting your invitations tomorrow, okay? But for those of you that are interested, so we have like a 48-hour window where we are allowing our tools members first crack at this, because we've never offered it before. Like I said, it's never been offered before here with OptionX Tom's Trading Room. And so we're giving you guys the first crack at this. We're also going to, well, let me just tell you a little bit more about what this is. It's a 5-week series. What we do is 90 to 120-minute live webinars with Jeff over the course of the next 5 weeks, starting not this Wednesday, but next Wednesday. You'll get 12 months of recorded sessions. So if you miss one or you want to go over it, you have them for the next 12 months. There are live case studies that Jeff will be supplying throughout the course. Obviously, live technical support is going to be throughout the course as well. You'll have access to Jeff between sessions through his members-only discussion boards, and of course, much more. There's a calendar trapper button where Jeff has taken all of the information that he's going to be sharing with you and has really put it into one button, which you'll have a couple of little radio buttons in there to toggle things back and forth. This button will allow you to find the very best bullish, bearish, and neutral counter spreads. It has historical built-in back testing. All right, so we'll be showing you how to use that. You'll be able to find these optimal calendars using something called skew, all right, which Jeff will be teaching what is the best skew, because sometimes too much of a skew is not a good thing, and he's going to explain that in this series as well. There's also built-in wizards in the calendar trapper button that will allow for back-to-back spreads, rolling spreads, and also what we call distant calendars as well. So that's a button that comes, and that's good for life. So when you as you're taking the class, you get the calendar trapper button. That's yours for life. As long as you're an active member of our tools, you have access to this. There's no additional cost that we charge for the calendar trapper button. It's almost like getting the keys to the Delta neutral sports car that you've just learned how to drive. All right, as long as you put gas in the car, and the gas is the tools. But all of you are using tools. That's why you were invited to this special webinar tonight, because you're all using the tools. You're all tool members, so you have the access to this in addition to your tools as a member or a graduate of the Calendar Mastery Series. All right, so this is included. Now I got a triple bonus for our tools members. That's those of you that are on this particular program tonight. We are doing an open call for any of our new members that want to join. That'll be Wednesday night. And in fact, I'm even going to give you access to the Wednesday night webinar. That's going to be very similar to this one, but I think it's going to be a little bit more detailed in terms of what a calendar is and why. We know we treat you guys as if you know a little bit more than the average member, because you're using our tools, but it'll be a little more detailed, a little bit more basic, if you will. But the triple bonus we have is this. First of all, we're adding on a 6th week. All right, we actually did this with Mike's class, and everyone was excited about it. So I talked to Jeff about this, and we're going to add in a 6th class. So there'll be a bonus week, which is going to be on the back of the 5 weeks we have. It's really going to be one of those follow-up where he'll go through all the 5 weeks together and just case studies. and questions and answers. So it's going to be another session with really much about live case studies. This is a 6-week mentoring class where you get to mentor Jeff along with what he actually does with calendars. Bonus 2 is a money back guarantee. So this is really easy. All right, we try to make it as easy as possible. You're not sure whether calendars are for you, but you want to try out the class, sign up, and you can take the class for for week 1. If you just realize it's not for you, then you email us back before week 2 starts. We'll give you a full refund. Bonus 3 is the tool members discount. So we're doing a tool member discount. Now, the regular price on this is $29.95. And you're going to see, if you want to join us Wednesday, that the price that the folks are going to get on Wednesday is going to be significantly higher than our tool member price. We know you guys already use tools. So for that, we're giving you a discount. And so you're getting $1,000 off the regular price. So you're going to be able, actually more than that. You're actually getting $1,500 off the regular price. It's $14.95, and you save that by joining up now. So obviously the big question is, where do you go to join? All right. So the site, and this is not published, but I'm gonna actually put it right in the chat box. It's tomgentile.com/18calendars. All right. So if I grab the chat window, I'm going to put it in here for you, www.tomgentile.com/18calendars. All right, there you go. You click on that, and it's going to take you to this website that you see now on my screen. So that's the 18 calendars website, and it'll explain everything that I just talked about, all right, along with the only 25 spots available. All right, if you click on either of these orange buttons, it's going to then take you to our terms of service page. All right, read the terms of service. If you agree, you click on the I agree page. That'll take you to the PayPal account. If you have a PayPal account, you can go ahead and pay through PayPal. You'll see the special price that I just gave you is on the PayPal page. You would just simply log in, and you could pay that way. Or if you do not have a PayPal account, which many people don't, you click on the gray button, pay with debit or credit card. If you click on the gray button, it'll then take you to a PayPal guest checkout where you can use Visa, American Express, MasterCard, or Discover. Just fill in the information. Once you're done, click on Pay Now. Once you do pay for the program, what's going to happen is you will instantly, upon payment, get the confirmation email from us along with the link to week number 1 for the registration. So you're in for the 6 weeks, and you'll get the link to the registration. All right. Again, we only have 25 of these available at this tools only special price. They will go. They always do. All right. And they always go faster than the 1 week time slot that we have. They expire in 1 week. We typically, it happens much quicker. If it does expire, if you don't make it in the first 25, you get put on a waiting list. If a spot comes up, and very seldom something does happen, and where somebody says, "Oh, I can't make those dates, maybe next year, whatever it is," and they do a refund, then we will get a hold of you. But that typically does not happen. You know, once we reach that number, you'll see sold out when you try to log into the 18 calendars site. So again, guys, I put it up there for you. And let me just punch one more in the Q&A box to make sure all of you have the ability to get that head start before Wednesday for sure. So what we're going to end up doing is this is going to go out because of the amount of folks that are here tonight. There wasn't, obviously, we had many more of our tool members register, all right, than were able to actually show up, all right. But again, once they get a hold of this, that's when the numbers are going to dry up pretty quickly. So you as a live member have the ability to jump in this right now. It'll probably be an hour or so before this is sent out to everybody. So you got a little bit of time. The other thing too is that I want to mention that this is a once a year program. Jeff doesn't do this. We only do our mastery classes once a year. If you don't get in this year, it's, you know, we do it next year. all right, sometime next year. But these are not something that we put on month after month after month. You know, you're hearing from Jeff right now. If you guys want to come and join us on Wednesday, you can hear from him again. But other than that, in his mastery class, we really only offer them once a year. All right. So I did get a question on timing, but yeah, we'll offer it. You know, we will offer it sometime next year upon Jeff wanting to do it again. All right. Yeah. Hey Jeff, Richard wants to know if we could show him what's in the calendar trapper button.
That's up to you, Tom.
I mean, why not? I mean, you know, you know the button better than I do. You want me to just throw it over your way for a moment?
Sure, you can. Yeah.
Okay, then let me go back and share the screen with you, because we do have most of everyone still hanging out. So let's just show that real quick. We got a few extra minutes here, so let me find you. All right. Yeah, just show them how fast, and once they learn it, just say, okay, assuming you know it, this is how fast the calendar button works.
Yeah.
So you now have the controls again.
Okay. All right. You can see my screen. Can you see my that spider trade?
Yes, I can.
Okay. So remember a few moments ago, guys, I showed you this calendar spread, but this link here that gives you all of these choices, right? Well, we went a step further and we created. This is a lot of button clicking and a lot of searching. So we went a little further, and we created a button. So the calendar trapper button. So here's what's in it. So here's what happens. Now you got to remember, the first step is over here on your left in this section here, guys. One of the most important things is a list. All right. So you have the ability of inputting whatever list that you want to create, whether it's a personal list or whether it's one of the pre-conditioned lists. And we're going to talk a lot about lists in the class. And then we kind of come over here to the search controls and maximum entry price. You can see it's defaulted here to $125. Well, remember, you can set that to whatever you want. If you don't want to spend more than 50 bucks on a trade, you put 50 in there. All right. Now the max risk, you'll see a difference here. You remember there's always on a debit spread, your max risk is your entry price. Well, with calendars, it does work a little different because of skew, but most of the time, 99% of the time, your entry price is your maximum risk. But we put in here really for diagonals, okay? Because diagonals gets a little, it's an advanced type of strategy and it gets a little squirrely. But what's really cool,
so hit that search button. I want to see some end result.
All right. So this is let me pick. Well, let's go ahead and do word that quiet. Okay. So we're going to do quiet. We're going to do this. All right. So we're going to do at the money. We'll leave it on puts. We're going to do a calendar, basic calendar. We're going to do a back-to-back. So we have these selections here. We're going to just click search. Now,
guys, notice, Jeff's going to be teaching. You know, I mean, he just threw at you a whole bunch of stuff.
I did.
That most of you don't understand. All
Guilty.
right, so he's going to dissect all of that in the class, so that when you're running these searches, you'll know exactly why you're doing what he just did.
Yes. Now, one thing here is you'll see here in this search controls box where it says backtest calendar days, single stock. This is really cool. Now, it didn't pop up here because we searched several stocks. Okay, look at our search results. We got some nice research. We're going to check some of these out, Tom. This back test is really cool, but we have to do it on a single stock. So we'll get into that in class. But what it does is for a single stock, like for example, a JP Morgan here, if we search JP Morgan and it found 6 other calendar spreads within the past 120 days, it's going to tell us how those performed. It's really cool. It's really, really powerful. All right, so let's just kind of take a look at our results here. We have 8 results here. You can see here, there's probability of profit here. I really don't pay attention to this very much. One thing is I do pay attention to skew. Okay, we do want to pay attention to where earnings are. Okay, days to expire and earnings. Okay, so earnings is 101 days out here on these, 94, 81, 74. So these are all good. Oh, it looks like XLY is ETF, so it doesn't have earnings. So let's take a look at one of these. So how you take a look here, we'll just look at the first one, is just click on the option quotes to bring up the trade. All right, so this has already got some of my predetermined filters built in, and I will tell you what those are, in our class, because let me share with you briefly one little thing that happened to me years ago, and I've carried it with me till today. Years ago, I was teaching a class with George Fontenilles out in Las Vegas. It was an advanced option X class, and I got asked a question in that class that stopped me in my tracks. And it was simple, but man, it left a long-term impact on me. And the question was, what are some of the nuances in this trade? What are some of the nuances in this strategy? Nuances, the little things that make a big difference. And man, I'm going to harp on that during our class. And I'm not holding anything back. I'm going to let you know everything you need to know. All right, so let's quickly kind of review this. What do you think of this? We have a stock that has, just all of a sudden sold off and is trending kind of downwards. Now, the reason why this appeared on the quiet SV list is you can see here, look at the price. It's in $2.20 increments. Okay, so it's, relatively quiet. And look at the median. If you were just, oops, can't draw a line. If you were just to kind of draw, it looks like this 5620 level is kind of the median price. So it's been floating around that level. You can see 5620 was support, resistance here. Look at that. Look at that resistance at 5620. Popped through it, came back down through it. So that's why this ended up on our list. But personally, I think I would need my break evens quite wider than they are for me to really kind of consider this particular trade. So you know what I do with a trade like this? I hit the little X button up at the top and I go to the next one. All right, so we have this particular trade at 94. What I want to do is, man, these are all, let's look at CFG, priced at, or currently trading at $40. Let's take a look at this one. Okay, debit's $50. Okay, look at this. Okay, it already had earnings. Okay, stock has spent quite a lot of, look at this. It was trading around 42.20 was the median price, and it has worked its way down, and looks like it found a more favorite spot here around the 40.50 level. Okay, so this is the Citizens Financial Group, CFG, risking 50 to make 67.30. So that's the potential for 134% return. Can I double my money? That's one of my questions. The answer on this is yes. I have the potential to double my money. Why do they call it a delta neutral trade? Well, I can tell you, when your delta is under 1, you're delta neutral. And you can see there it's 0.83. Okay, when your delta is 1 or over, well, that means you have 1 share of stock. If you have a delta of 1, you have 1 share of stock. If it's -1, you're short 1 share of stock. Here, we're pretty much considered delta neutral. All right, so we're going to go through all of this. This is actually halfway decent. So how I would manage this is, if I were risking $1,000 in each and every trade, and I only wanted to risk half of that in my position, then how I manage it is, I told you before, I'd only put $500. I would only trade 10 contracts instead of the 20 that I might have traded otherwise. Look at the open interest in this, thousands of contracts on each leg. This is nice looking all around, real healthy open interest. Okay, I'm not worried about volume. As long as the open interest is there, I'm not worried about volume at all. that sort of thing. So this is in a sense what the calendar trapper does. Did you see the kind of the difference between okay, let me show you a quick difference here. Let's go back up and go to the searchers. We'll go to single strategy. We'll go to this calendar spread. Let's do at the money, and let's search the same list, okay, and see how many trades we get.
And I think, Jeff, you know, I mean, trying to compare one of these to the other is a little different, is tough, because what you're searching on now is a blanket list that doesn't factor in a lot of the proprietary information that you do. And so that's why you're seeing so many more, because it's not factoring in the stuff that you're going to be talking about in class.
That's exactly right. That's exactly right.
I think it's good to note that, is that, you know, at the end of the day, there is inherent differences between your calendar trapper button and the regular calendar spread scans that we have that were created by a lot of traders who were creating those that wanted different aspects. That's why you get so many different trades there. But in fact, I want to show them an idea of what like the back testing is going to look like.
Okay, before we jump there, let me just stress what you just said. Tom's absolutely right. It doesn't mean this list is bad. There's a lot of good trades here. I can tell you right off the bat, because I looked at it earlier. But the thing is I'm able to, with that counter trapper button, I've reduced it down. Oops, sorry. I've reduced it down to look at the cream of the crop of that list, based on very specific criteria that is based upon years and years of trading and success. Okay, that's the difference. There's a lot of other filtering, and we'll go into that in class. I'll be happy to dissect that in class. So Tom, you wanted to see the back testing part?
Well, I'm just going to show them some of the just real quick, kind of give them an idea of what to expect when you see something like that. So
yeah, well, here I can build.
I took something.
Oh, you did it already.
Similar.
Okay, great.
I took something that's similar to show them, kind of the ideas of what we look for. And so get an idea. Green is profit. This is an expiration where you had one side expire, and then of course the red is a loss. But you can kind of see here a lot of green on the screen. As you look around at what, and this is going back, this is a 1,200-day search. This is just one of several different ones that we're going to show you in class over the over the next 6 weeks now. So that's it, guys. Thank you for joining. Jeff, any final comments?
No, just really excited to have everyone on board, and we're going to get started with a bang a week from Wednesday. And jump right into it. This is a great time of year to be doing calendars, and look forward to having everybody on the calls.
Awesome. All right, guys. Well, thanks again. Have a great evening. Hopefully, we were able to educate you on something completely different than we've done in quite some time. And I'll have recording and more back over to you here within the next hour or so. And again, if you have any questions, feel free to email us, support@tomgentile.com. You can call the office if you want to. Have a great evening, guys. We'll talk soon. Bye now.